In this video, I'm going to use CVP analysis to determine the effect of changes in unit sales and net operating income. So we're starting with a company for this month, and we've got their contribution format income statement. We've got their sales when they sold 10,000 units is $350,000 in total, and that would be $35 per unit. Their variable expenses in total are $200,000. Again, having sold 10,000 units, it'd be $20 in variable expense per unit, and their contribution margin, $350,000 in sales minus variable expenses of $200,000, $150,000 in total for contribution margin. On a per unit basis with 10,000 units, that would be $15 in contribution margin per unit. Subtract total fixed expenses of $135,000 from their contribution margin of $150,000, and they have a net operating income of $15,000. That's where they are now at 10,000 units sold. What we want to do is use the power of CVP analysis to determine what would happen to net operating income if we change the sales level. We're using it to predict. For example, in our first scenario, we want to know what's the new net operating income going to be if our volume of sales increases by 100 units. Now, our starting point is going to be where we are right now with 10,000 units of net operating income of $15,000. To that, we're going to add the contribution margin earned by each additional unit that we sell. Keep in mind, $35 per unit sold, subtract out the variable expenses that has to cover first of $20 per unit. That means every single unit sold contributes $15 first to hopefully cover our fixed expenses, next to hopefully earn net operating income. So no matter if sales are going up and down, it's going to increment by $15 per unit of contribution margin, either being added to net operating income or subtracted. Here we add 100 units, so 100 units times $15 in contribution margin per unit is adding an extra $1,500 to our existing net operating income of $15,000, bumps up our net operating income to $16,500. Now we could have restated our whole entire contribution format income statement at 10,100 units instead of 10,000, but why do that when we can much more quickly determine the effect on that operating income? Our second scenario here is a decrease by 100 units. Going to work the same way that we did with the increase, just we're going to subtract it instead of adding it. These are independent scenarios, so we're going to go back to $15,000 in net operating income to start with. Now we're going to subtract 100 units at $15 per unit, or subtracting 1,500 brings us down to $13,500. I'm going to let you go ahead and work the last one on your own, where they're saying restart with 15,000 in net operating income, but this time decrease your sales volume to 9,000. Just as a hint, keep in mind, currently it's 10,000. We're bringing it down by 9,000. That means we would be losing 1,000 units.